This episode is brought to you by Audit Shield, the service that protects CPA firms when the CRA comes calling. Audit Shield ensures every hour you spend responding to audits or reviews is fully covered.
Welcome to our AJAG PD Pod, the place for discussion, debate, and learning about all things accounting. Our hosts, Ivan Tabak, Jonathan Tucker, are CPAs that have been in practice for more than 3 decades. Together, they bring varying experience and viewpoints to the table, not to mention a little humor, too. Join us as we talk through current issues and hot topics, tap into expert guest insights, and enjoy the odd walk down AJAG memory lane. Before we begin today's podcast, please note, although the educational material within the podcast has been carefully prepared, none of the persons involved in the preparation of the material accepts any legal responsibility for its contents or for any consequences arising from its use. As well, the podcast material and the references contained therein may reflect laws and practices that are subject to change. Advice regarding a particular fact or situation should always be reviewed by a qualified professional. This podcast is produced and distributed by AJAG Professional Development. For more information about AJAG or any of its offerings, please visit ajag.ca.
Welcome to Season 3 of the AJAG PD Pod. I'm Ivan Tabak.
I'm Jonathan Tucker.
And for our first episode of the year, we're pleased to be joined by Hemal Bulsara, Head of the Tax Retirement and Estate Planning Services at Manulife. Welcome, Hemal.
Thank you. Thank you for having me.
Great. So, life insurance, it's one of those topics that everybody in our world, wants to understand, but often doesn't at least properly. And we come across policies, we don't always know all the terms, the features, and whether it's doing what it's supposed to do. So hopefully we can uncover some of the mysteries and at least know who to talk to when we have questions.
And for those who don't know, I've worked with you, Hemal, the last maybe a couple times over the last 10 years, maybe.
Absolutely.
And so Hemal's been a great resource just to reach out to when I've got a question. And so hopefully some of that content can come out today. But before we get into it, a little bit about yourself. You're a CPA CA?
Yeah, I'm a CPA CA. I also have my TEP, my FEA, and a CFP along the way as well. But in terms of my accounting background, it actually started like when I was back in grade 11. Like I took my first accounting class and I ended up getting 100 in the class. And I was like, oh, this is amazing. Such an interesting, I found accounting interesting with debits, the credits, all of that good stuff. It was the math and everything like that. But what became evident to me was when I started telling people I wanted to do my CA, what ended up happening was they started asking me, do you know anything about tax? Do you know anything about tax? Do you know anything about tax? So it became very evident to me that if I could figure out tax, there would be opportunity for me. And at the end of the day, what happened was I quickly also realized rich people pay more tax than people who may not have as high incomes, right? So if I could help affluent families in terms of their tax planning, good things will happen. So fast forward, what ended up happening was as I joined Ernst & Young, I was in their audit practice. I started off as a summer intern, and then joined them full time, and then, worked through my audit hours. But what became evident to me was...
You didn't like auditing?
I would say I'm not the unicorn who does, but, I also appreciated the fact that, I got an opportunity to make some incredible friends who become lifelong friends, and just had the opportunity to work with some incredibly amazing people, but it wasn't the subject matter that I was interested in. And I ended up crossing the street, moving over to PwC and their high net worth tax practice. And ultimately it was one of those things where it was an incredible experience for me, because not only do we get to do interesting work, we had an amazing team, and it was just one of those things where it really became a great place to learn, great place to help clients, and a great place to just really get my foundations right. And I ended up making the move to Manulife in 2011. And part of that was just, I really enjoyed my time at PwC, but my challenge was my first daughter had, just been born. I was kind of going through the first year album, and I'm like, I don't recognize half these pictures, right? And I started realizing public practice, although it's got a lot of great benefits to it, and a firm like PwC is awesome. I just realized, for me personally, the work-life quality wasn't there, and it wasn't driven by necessarily the management or anything like that. It was just more the expectations I put on myself. And what ended up happening was long story short, I ended up moving crossing the street to Manulife, and it's been an incredible experience where I've been able to be immersed in the world of insurance and tax. And I think that's one of the reasons why I'm here today. So
Well,
it's been about 15 years for me. So yeah,
it's one of those areas where I think there's a handful of people in Canada that know it well.
absolutely.
Okay. And so then we find ourselves in practice with a client emailing us saying, I'm being told by my agent, this is the policy I should, and that's how we find ourselves in these situations. Sure.
Definitely. It's not easy. And I mean, one of the things, my own experience, like, when I first joined Manulife, I thought I knew a lot about life insurance. And then once you get immersed in the world, you realize you just know the tip of the iceberg, and there's way more to the iceberg than just the tip, right? So similarly, like, I can appreciate where you're coming from as well, because the reality is this stuff is complicated. And as client needs and structures have evolved, it just gets more and more complicated. So, hopefully I can lift some fog for you and your audience today. So
And so do people reach out to you?
absolutely. Absolutely. I mean, like, I find in my network, there's always a few questions that come up. Like, I'm heavily involved in the Society of Trust and Estate Practitioners. But I just have, like, people, just calling me, reaching out with questions on a variety of different issues. And, if it is a Manulife related issue, happy to take the conversations.
And what if it's not a Manulife related issue? Because that's happened
Yeah,
for you and I,
absolutely.
right?
Absolutely. And I mean, like, definitely, like, my concern is I don't want to open up the floodgates, right? Where it's like, 3,000 people reach out to me, but like, like,
It could be a good problem.
Yeah. But at the same point in time, it's one of those things where, if you are an accountant and you're curious, or you're encountering an issue, feel free to reach out. We could kind of figure things out. So
Yeah, absolutely. Good.
Everybody that's watching this, has some familiarity with life insurance, and I'm sure with their clients, etc. But what would you say are the top, 2 or 3 areas that, we really need to be more aware of, and some of the planning issues, and within the, the context of our podcast, without, obviously we can't get into, extreme examples, but, where are the best areas that we should be considering, and what are the specific issues within those that you find are often overlooked,
absolutely.
that we should be aware of?
Okay, great. Yeah. So one of the things I want to emphasize to the audience is really from a macro perspective, what happens with life insurance it's first off, the fundamental pillar is really the risk protection element of life insurance, and getting that liquidity. Because remember, life insurance provides an immediate death benefit when the insured passes away. So before we layer on any of the tax planning, the fundamental pillar is risk protection. So be it, funding terminal taxes, be it to, ultimately have a death benefit flow to your family members, to cover off the risk of you passing away, be it to, fund a shareholders agreement. At the end of the day, the first fundamental pillar is really looking at that insurance need, because the other thing too that happens with life insurance is it has to go through an underwriting process, right? So if you can demonstrate the need, now all of a sudden there's the opportunity to get the insurance. And obviously you have to qualify as well, from both a health and a financial perspective on that. So that would be like the fundamental pillar, the first fundamental pillar. But then I take a step back and I think about the opportunity that exists, because life insurance benefits from, a few different things from a tax perspective. And the first thing is, if we do it in a corporation, we're able to use our tax deferred dollars that are in the corporation to fund this policy. Then during the span of growth, like if you have a policy that has cash values that grow, now you've got tax exempt growth. And then the beauty of it is the death benefit gets received tax free in the corporation. But not only that, we also create a CDA credit. And if you think about what we've done, using tax deferred dollars to fund the policy and then getting CDA creation on the tail end, what we've done is we've effectively crystallized the tax deferral and basically turned our taxable retained earnings into tax-free capital dividends. And that's really the magic of life insurance is really that creation of CDA at the tail end. But there are some speed bumps along the way, right? So the one thing a few things that you want to be careful about when you're working with corporate-owned life insurance is the first prize in the corporate-owned insurance world is let's try to hold this policy in a corporation that we're never going to sell. We also want to consolidate owner, beneficiary, and payer, because a life insurance policy has three parties: the owner who owns the policy, the beneficiary who receives the death benefit, and the payer who's paying the premiums. And when we start separating those parties, right, the owner from the payer to the beneficiary, all of a sudden we could back ourselves into a series of shareholder benefits, indirect benefits, all of these other nasty provisions. Plus, if we designate multiple corporations as a beneficiary on a single policy, that ACB can grind down multiple CDA credits. So there are complications. So first prize in that universe is having, really the owner, beneficiary, payer being the same party, right? So that would be the other fundamental pillar behind this. And really the third thing that I would say is really one of the things I've been finding is like, ever since the 2024 proposals for the capital gains inclusion rate, all of a sudden bells and whistles have been going off in everybody's heads. I got a tax liability due when I pass away. And now this beautiful corporate-owned life insurance policy can actually provide, like we could use our corporate dollars, receive that CDA credit and that death benefit, and then strip out the dollars to the estate to fund terminal taxes. So when you layer this on with post-mortem planning, like, the redemption loss carryback or the pipeline strategy or whichever one is ultimately chosen, the results will be enhanced for the client and their estate beneficiaries.
So the speed bumps that
Yeah.
Ivan was saying, I guess, is the capital gains exemption.
Yes, absolutely. So that's definitely
Small business deduction, where high income
so.
corps.
So
It avoids the grind.
yes. So the good news is
And for those who are watching who are in Ontario, that's a different regime provincially than it is federally.
absolutely. So the speed bump. So the good speed bump is it's not really a speed bump. I guess good speed bump is just there's no bump, right? Like, but the good thing with the life insurance is it benefits from tax exempt growth. So you're moving on dollars that would be in a taxable environment, taxed at the investment income tax rates, considered adjusted aggregate investment income, and now all of a sudden we're throwing it into a policy where it wouldn't be attracting that. Often I don't try to use that as a lever, like when we're talking about this opportunity, but like it is a great side benefit to having moving dollars from a taxable environment into tax deferred environment. Yeah. So
And then the scenario we were talking about was where an opco owns a policy and it gets sold. The shares get sold. And so what do we do in a situation to avoid that type of scenario?
Absolutely, and that's a wonderful question, and it's a function of two things, right? Like, I would say option one is trying to get the infrastructure right from the beginning. So one of the things that I would say is and what I mentioned in earlier was just try to hold the policy in a holding company we know we're not going to sell, because that has a series of benefits to itself. Because the reality is why I say that is when we transfer policies, there are tax implications to a transfer. So, for example, if we did have an operating company and I was the sole shareholder of that operating business, and I decide to sell that corporation, the first thing is that cash value is considered a passive asset. So now it may impair my lifetime capital gains exemption qualification, right? So you've got that 50% and you've got the 90% test. So especially with the 50% test, if we have too much cash value, it could potentially put us offside for the 50% test. The reality is by stripping it out of the corporation, we could potentially qualify for the 90% test, but that 50% test for that 24-month period could be potentially impaired. So that's the first thing. The second thing is a transfer of a policy. Let's just say, for example, I did want to transfer that policy out of the corporation to myself. What would happen is assuming that we just transfer it out as a dividend, what would happen is the corporation would end up being in a situation where it would have a disposition of the policy. And under 148(7) of the Income Tax Act, the proceeds would be the greater of CSV, ACB, or consideration. Our consideration is nothing. So it's really CSV versus ACB, right? And if our CSV is higher than our ACB, we've got a fully taxable policy gain. And that fully taxable policy gain is treated as investment income in the corporation. And then in addition to that, as the shareholder receiving it as a dividend, I've got to pay dividend tax on the fair market value of the policy. And fair market value is often different than CSV or ACB. It's actually needs to be determined by an independent actuary, and they rely on Information Circular 89.3 to determine this. But they take into account a variety of different factors that start off with cash surrender value,
Right.
and then look at replacement cost of the insurance, and there's a series of factors that look
Age, and also the health
age
of
and
the
health,
individual.
yeah.
age and
If
health.
you've got someone who's sick, the
Yeah.
value of that policy
Is very
is going
Absolutely.
significantly,
Absolutely. So all of these factors go in, and all of a sudden you get hit with a fair market value income inclusion. It'll be treated as dividend income because in our example, we thought of it as a dividend. But the reality is if you just simply transfer it out, it'd be treated as a shareholder benefit, which is even worse, right? So
So these examples are all talking about permanent policies,
That's
right? But often we'll find clients that have just term policies in their corporation. Now, there's the argument, is that the best way to go or not? What's the plan? What's the reason for term or not? But if it's term insurance, then there could still be fair value issues there, but I don't believe it would be as significant as a permanent policy. And
Have you
nor
run
would
into that? Have you run into a fair value consideration in your files at all?
not yet.
No, I
Not,
haven't.
not yet.
Yeah.
But I do have operating companies where the owners have term
Yeah.
policies, not permanent policies.
yeah.
And in one particular case, it's they bought 20-year term,
Yeah.
and their thought was like, within that period of time,
Yeah.
they'll either retire or the company will be sold.
Yeah.
So they didn't want to build up significant cash value. The policies were there, for crisscross, buyouts of the shareholders if anything happened. So that would be, obviously less of an issue. Not to say that again, there's no value in a term policy, mainly because of health, I presume.
Have you run across valuations
Yeah.
on term
Yeah.
where it's an issue?
Yeah, the short answer is absolutely. So there's three drivers of value in terms of the term policy. The first driver of value is the fact that, you've got prepaid premiums in the policy. So again, that could be a small number or a big number, depending on the size of the policy. The second part of it is now the conversion feature.
Yeah.
So some term policies are convertible
Yeah.
to permanent products. Other policies are not convertible to
Are most of them
products.
or not?
I would say a good chunk of them are,
Yeah.
but some carriers don't offer convertible term policies. And that becomes an issue because if you can't convert it to a permanent product, all of a sudden you're now in a situation where that policy has likely lower value. But if you can convert it, all of a sudden you've opened up Pandora's box, because a convertible term policy often allows you to convert the policy to a permanent policy without going through underwriting.
Yeah.
Right. So that's
So somebody who's had a health problem,
exactly.
That gives you value.
that's their only source of income.
Yeah.
Or only source of insurance. Yeah.
Exactly. So that's what makes it powerful. So really, the conversion feature combined with poor health are really drivers of fair market value of term policies. So that's so the reality is
how many files we see where there's term policies sitting there?
Never even thought of that.
Somebody's now 60 and
had a heart attack, stroke, whatever, right? So
and they're looking at saying, well, now I've got a large tax liability from my holdings, and this is my only source of insurance. Better trigger that conversion feature.
Absolutely.
Wow.
And that's the beauty of the life insurance, is these conversion features. So many of the major carriers offer that as a feature on their policies. So it becomes a great way to not only guarantee your insurability today, but also give you optionality in the future in terms of making over.
So the planning, then, you were saying ideally if you could hold this in let's say it's a permanent policy.
Yeah.
And there, I'm always confused between permanent and universal life. So they're just features, but it's still permanent insurance, right? So
Yeah. So great question. So in terms of, the if you were to kind of break it down, right, there's temporary insurance, which is like
which is term,
which is term, but like there can be permanent term policies too, like term to 100
right?
contracts, right? So term to 100s, you pay the same level premium for, basically up to the age of 100, right? Like, or you could prepay some premiums. Anyways, there's lots of different ways to structure, but the point is term to 100 is permanent. There's also term 10, term 20, term 30, term 65.
Right.
But the point is like, they expire at a certain point in time. So often insurance advisors describe that as renting your insurance, right? Like, but I look at it as a great way to protect your risks. But at some point in time, there's often the desire to make sure that you have permanent coverage, either there being a tax bill, you want to leave a certain legacy to your family members, whatever the reason. There's lots of reasons to have it. But the point is a permanent policy can provide you that. And in terms of permanent policies, there's different ways to do that or to get one. One's a universal life contract, like you identified. Another one's whole life, of participating. They could be participating or non-participating. But the point is there's this whole life product. And then really, we've also got these term to 100 contracts, right? Sometimes they're known as yearly renewable term contracts, but the point is at the end of the day, you've got a permanent term contract. So those are the three ways of kind of getting to a permanent policy.
Yeah. Okay. Welcome back, everyone. And we've just been talking about how to put in place plans that are there in the event of risk. And so deciding ahead of time how risk gets handled is not something that's unknown to Audit Shield. Jason, good to see you again. How are you?
Not too bad, Jonathan. Good to see you too.
And today we're talking about this theme of risk that comes up. And you folks work a lot with CPA firms and dealing with risk. So let's talk about that a little bit.
Sure. I mean, we could take a look retrospectively at what kind of claims activity that we saw at Audit Shield towards the end of last year, leading into 2026. So I brought my notes here with me to share with you, what CPA firms can expect reasonably from what they're going to see on the on behalf of the CRA over the next coming months. What we have been seeing, you could say just in the last quarter and into the new year, is a big focus on processing reviews and follow-up requests to those processing reviews. I highlight that because we compare this time period to last year, same time period, and we're seeing a massive increase in this area of focus. And it's not traditional audits. What we're seeing.
What you're seeing.
Yeah, it's like the information requests, the clarifications, the second looks, the close the file down, let's reopen it. And the position hasn't changed. You still got to chase down the extra work or extra information that they're looking for and submit it back to the CRA. And this is work that oftentimes is very difficult to go back to the client and bill for. Obviously, this is the work or the time that we cover for ours.
Any areas in particular you're seeing?
Yeah, I mean,
and different across the country, or is it the same?
I would say so we do work with firms across the country, and we haven't narrowed it province by province. But you know what? Just to your question on where we're seeing the level of activity right now, let me just show you some points of interest here. Just in the last 60 days. What we're seeing is the industry areas that are creating the most unplanned review and audit work. Here's our top 5: construction and trades for sure. This is where it's revenue recognition, it's the subcontractor work, GST, HST, the payroll alignment stuff, right? Professional services, serious big. Back into that big time right now. Expense deductibility, the income matching stuff. Real estate and property related businesses, no surprise there. The rental versus business income, GST, HST on the capital versus current expenses. And then a couple of others, transportation, no surprise there. Payroll, source deductions, fuel costs, cross-border. And then retail, e-commerce, and gig economy, the sales reporting, GST matching, and the platform data is the stuff that we're seeing right now versus the reported income. So
I'll be interested to see if there is any uptake on cryptocurrency and how those things are reported now.
Yeah, well, keep an eye on the letters that we're seeing submitted for claims or for to have the timer covered.
So why does Audit Shield feel particularly relevant? right now, I guess is the question.
Well, I suppose it has to do with the way that the CRA is sort of shifting their focus. I mean, we took a look at sort of the stress areas when we look at the kind of claims that we're seeing, say, this past year and as it's trending forward versus previous years. So, for example, what we're noticing is that the CRA interaction has shifted from that exceptional, maybe one-off here and there on an intense audit, more so to routine oriented, where it's the ongoing post-filing interaction as part of normal practice. Some of the other things that we're looking at is that most of the work now comes from the post-filing and the second looks.
Right.
Right. As I mentioned, processing reviews, matching requests, and those clarifications, which typically shows up months later after the...
Are you seeing an increase in the number of claims and the number, from your members?
Certainly over the last 60 days. So going from last year and into early parts of the new year.
Yeah.
We did see a significant uptick in the number of submissions for processing reviews in particular.
That makes Audit Shield a little more relevant.
It does, because it's time thrown away that generally creeps up on you. Because when you think about it, it's maybe a half hour here, an hour there. And then when you do an aggregate across the firm and you recognize that oftentimes this is very difficult time to bill. And then next thing you know, 20, 30, 40 hours is thrown away. So our simple position on that is, look, you need to be able to recover 100% of your time, regardless of it being a processing review or a full-blown audit, and everything in between.
Don't let that time be wasted.
Exactly.
Yeah, very good. So if CRA activity is already starting to creep in, and you want to turn your least recoverable time into fully billable time, then connect with Jason at Audit Shield. The contact information is on screen, so feel free to reach out. Jason, any other final comments?
No, that's it. And it's always a pleasure to see you, Jonathan. And here's to a productive tax season ahead.
Very good. Thank you, everyone.
So, when you're looking at a permanent policy and the investment pool within it, from what I've seen, typically the returns on the investments that are available to you within those policies are not as good, not as attractive as, similar investments outside. I mean, the fees, I believe, within of the funds, generally funds that, that you can access within the policy are very high, because they're insurance products.
And they got 2% tax going in.
And the 2%, yes, of course. So you take the hit right off the bat on your capital coming in, but if it's there long enough, being tax free, you can overcome that. Yeah. But the returns themselves, am I off on this, or are the returns generally lower within?
But then there is no tax on it from that standpoint.
Oh, I get it.
That part, I guess, offsets that to a certain extent.
True. But
so I would say, like, the one thing that compared to a stock portfolio, one shouldn't try to take excessive risk in a life insurance policy. So usually when we're talking about the types of policies now, we're talking about a universal life policy where you can choose your investments, right? So the one thing that I would say is like, one would be a little bit, more risk averse in their policy, because you don't want your values to go down, right? Like, so the inherent nature of that may lend itself to returns that may be different than when a person would experience on the stock market, right?
Right. You don't have self-directed investment pools in that pod of investments, right? It's specific funds or investment pools that the insurance company will give you access to.
Exactly.
But even still, for those more conservative type investments, I still have seen, generally much lower returns when you compare them to a similar type fund, like an international equity fund within the pool, within the policy, versus in your taxable portfolio, the returns seem to be much less. And yes, I understand, you're not paying tax on the return, within the pool. But I'm just curious,
And I would say
Why-
too, when I look at them, there seems to be a certain amount of mystery around how these earnings are, and you usually get an insurance advisor who's giving you a scenario out 20 years, and there's a whole bunch of columns on the page, and by the time you get over, you forgot. Like it's not an easy.
And I would say,
So
like,
it seems to be shrouded in mystery.
yeah, and I mean, it's one of those things where,
And the dividend rate as well, which
yeah,
I think is on a different.
yeah, so it's kind of like, and this is where I could appreciate, concerns from your side, where it's like, there's different products and like different things are treated differently, right? So, universal life is kind of like generally a little bit more flexible in terms of choosing your investment pools, right? Meanwhile, whole life you're relying on the insurance company to effectively do the investing, right? So, for example, a lot of the large carriers right now, they have like a performance dividend scale of like about 6.25, right? Like, or between 6 and 6.5, like, they range. But really the point with all of this is part of this process, and how I describe whole life, for example, it's more of a black box, right? It's harder to bifurcate, right, in terms of like how the values ultimately play out. And one of the things I would say for the audience is like, in terms of like, if you're looking at products, right, like regardless of whatever you choose, not only do you want to see more ambitious and aggressive assumptions, you also want to see conservative assumptions, right? So for example, coming back to the whole life discussion, right? Like not just, if the advisor who's promoting the strategy is showing current, that's great, right? Like, you can see what, results are based on a current scale, but always test it out at -1 or -2 for like a whole life policy. Because at the end of the day, what we want to achieve with any of this stuff is, we want to make sure that, the death benefit is sufficient to meet whatever needs that the client ultimately has. But in addition to that, what we also want to do with any of this stuff is also, test assumptions on IRR, internal rates of return, right? Because I would say when you're looking at any of these products, internal rate of return is probably the biggest thing, which is really cash on cash returns, right? So I wouldn't necessarily get caught up on like, like year to year, like investment details, right? I would more focus on IRRs, internal rates of return, where it's like, you put in a certain amount of premiums, what's the present value of that relative to the death benefit? And ultimately, if our IRR is a big number, that's a good thing. And if our IRR is a low number, hey, maybe let's reconsider the product choice, right?
So basically you're saying just ignore the fees. It's the IRR that.
Absolutely.
And what do you think about that? Because
I think it does make sense. It sort of puts the return, the annual returns more
in perspective. Yeah.
Yeah.
I mean, I'm not buying insurance necessarily just for a rate of return.
Yeah.
I'm buying it to solve some sort of problem I have in the future.
Absolutely.
But we're distinguishing between the insurance
Yes.
portion and the kicker being the investment pool, right? Which you don't have to participate in.
Yeah.
Right.
Yeah.
So, but if you are going to put the money in, you do want it to grow.
Yeah.
And to Jonathan's earlier point, really the beauty of the insurance is you get that tax exempt growth, right? And then all of a sudden, if we kind of bring it back to one of the things we talked about at the beginning, was really, if we do this in a corporation, we get CDA creation, right? To the extent that the death benefit exceeds the ACB on that policy. So now all of a sudden, we've got this ability to potentially recharacterize the dollars, all the dollars that went into the policy into a tax-free capital dividend, right? The only catch is the insured has to pass away. So at the end,
are you guys working on that at all? Is there a way around that?
Imagine, right? Like
other than borrowing money.
Yeah.
So borrowing, so that's the other thing. So if you let's say you've built up an investment pool within the policy, and now you need access to that capital. So the only way to get that is, well, the two ways to get it is you pull it out of there, and then you take a tax hit when it comes out of that investment pool, or you borrow against it. Now, the rates of interest that you're going to pay on that borrowing are not necessarily the most advantageous rates you can get in the market, at least from what I've seen.
It's the convenience of it, right? It's a phone call. I need, $100,000, and
so I think so we'll take a step backwards and then take a step forward on this, right? So, really, there's actually the three ways of achieving it, right? So the first way is doing a partial surrender of the contract. Problem with that is it creates a taxable disposition.
Yeah.
And you can potentially get hit with a policy gain because of that partial disposition. Another way of achieving it is doing a policy loan. So I think what you were just describing right now was there's a contractual obligation built into the contract where you can actually borrow money from the policy itself. And it's a contractual requirement. You don't have to go through financial underwriting or anything like that to achieve it. You just get your money out. That too, to the extent that the borrowings exceed our adjusted cost basis, will create a policy gain, right? So often, and because of the convenience of it being built into the contract, the interest rates are going to be higher than what one could borrow in the open market, assuming that they had, good credit, right? But really the third way, and the way that is actually, that a lot of the deals that we work on that involve leverage, it's actually a collateralization of the cash values in the policy. And why that's important, and that's an important distinction, is a collateralization of the cash values isn't considered a taxable disposition. So from a tax lens, we're not, subject to the same policy gains we would have with a policy loan. But in addition to that, what also happens is the financial institutions, the banks, actually regard cash values of life insurance policies to be high grade collateral security. And as a result of that, interest rates can potentially be as low as prime, depending on the client's credit and everything like that. So again, I'm not a banker, but one of the things I've seen is very favorable prime +1, at the most, right? But really the point is very favorable interest rates in the context of that. So a lot of times if you have a client that's being pitched an idea, I find more often than not, it's usually especially if it involves a leveraged life insurance policy, it's usually going to be something where we're using a whole life product and we're using a collateral assignment of the life.
Now that's a policy that's owned inside of a corporation. And if the person needs the money, you've got a taxable benefit. You've got a shareholder benefit. So any ways around that?
Yeah. So the first thing that I would say is if we take a step backwards in terms of this, as well is doing leveraging against a policy. In my mind, there's two ways of doing this. And there's a third way as well, but I'll talk about that in a moment. The first way is if we do it in the corporation is the owner of the policy, corporation is the beneficiary, corporation is the payer. Yeah. But in addition to that, the corporation is actually the entity that's doing the borrowing, and it's redeploying the capital in the enterprise to invest. Right. And why one would do this is, again, to grow the pie, right? You've got the growing policy, you've got the growing asset, and hopefully your asset grows faster than the loan. And as a result of that, your pie is ultimately grown. Yeah. And on the tail end, the death benefit is going to pay off the loan. But what happens, and this is the real magic of leveraged life insurance in a corporation, is the fact that, let's just say, for example, we had a $5 million death benefit and a $4 million loan. And let's assume that the ACB of the life insurance policy is zero. The corporation is getting a net $1 million of cash, but the CDA credit is based on the gross $5 million death benefit. So all of a sudden, we've created $5 million of total CDA or $4 million of residual CDA. And that residual CDA can be integrated into other planning, including post-mortem planning, to help reduce effective tax rates at the time we pass away. But the second piece of this is if we do this at the personal level, the person should be the owner beneficiary payer, and then they're borrowing at the personal level, and they're basically taking advantage of interest deductions. As you can appreciate, if you do that, you also have to consider AMT, right? So like, AMT will rear its ugly head, but there is the opportunity to do this tax efficiently. There's a third way that sometimes gets promoted, but I'm not a big fan of it. You need to have a sophisticated client who's willing to take on tax risk, where it's like, you've got the corporate owned policy, but now you've got shareholder borrowing against it.
Yeah.
Right. And to be honest with you, it's one of those ways where I like the first two way better than the third one.
Yeah.
Right. Like, just because
But the third one, though, as long as the shareholder is, my understanding is, as long as the shareholder is paying something for that benefit, for the use of the collateral, that offsets the shareholder benefit component.
Absolutely. But what happens? So you, if we break it down, right? Like, you have to pay a shareholder benefit, or pay the guarantee fee.
Yeah.
So there's this thing called a guarantee fee.
Yeah.
That you would have to pay to the corporation. So the first thing is like, the question is what's the value of that guarantee fee?
Yeah.
So now all of a sudden we may need to get a valuation, right? Like, of that, right? So there can be formal ways of evaluating it. There can be informal ways, but the point is how are we actually valuing that? Some people say it's just 1%, but I find let's actually come up with a proper valuation.
Yeah.
The second issue with this is in terms of the ball game, when it comes down to this, is in addition to paying the guarantee fee, from a math perspective now, if we have to pay interest every year, all of a sudden, sure, we benefited from some capital, right? Like, that was, that in the form of a loan. But now if we have to pay interest out of pocket and you've got a young person who's doing this, all of a sudden the cost of the interest could far outweigh, the benefit of the
over time though. But I mean, if you're looking at a 50% tax rate and you're paying 5%, you've got 10 years before you've paid more in interest than you would have in tax on year one. Is that a fair way to look at that?
I would say to a certain extent, but at the same point in time, I'm still like, when you look at the math and the accumulation of these loans, it all of a sudden doesn't look as favorable, especially
because after 10 years, maybe you have an equivalent cost, but you still have the loan.
Yeah, I know, fair enough.
Right?
Fair enough. Yeah. If you can repay the loan inside of that period of time, and then
you have a deferral.
Yeah.
And then the other piece of the puzzle here is like what happens on the tail end. So this is where, when it comes to unwinding these things, we have to be very careful. So the first step in the ball game is we never want the loan to directly be repaid, by the corporate death benefit. We actually need to have a proper tax cycle where the money goes through the corporation, gets paid out of the CDA, and then repaid by the estate, right? So that would be the first variable where it's like, we got to make sure we do this. So
why? What's the risk if you don't?
So the risk is we could potentially have a shareholder benefit for the entire amount of the loan, right? So having the proper tax cycle being paid through the corporation and ultimately being paid out of the CDA to ultimately be cycled to the estate and then ultimately repaying that loan is the better way of doing it. But you run into two issues here at the tail end, which often people don't talk about. The first issue is we're consuming CDA as part of the loan repayment process. If we do it just corporate borrowing, we get the full, coming back to our example, we get full $5 million of CDA after loan repayment. In the context of shareholder borrowing, now we're in a situation where the $4 million of CDA gets consumed as part of the loan repayment process.
Right.
So now all of a sudden, we don't have the residual CDA in the system, right? The second thing is the valuation of the shares. So if the shares in question are common shares, if we did corporate in terms of the borrowing, we have the cash value increasing the value of the shares, but we have the loan decreasing the value of the shares. So now all of a sudden, we're looking at things on a net basis. If we have the loan outside of the system, we have this cash value increasing the value of the shares, and now we don't have the loan offsetting the cash value. So all of a sudden, we're in an environment now where effectively we end up with a higher capital gain. So if you take into account, the value, the tax savings associated with the CDA, the residual CDA, plus the potential capital gains exposure, all of a sudden, we're now in a situation where that shareholder borrowing may look less attractive even more, right? So those are some of the considerations. So this is why I say, on the surface, it seems like a great idea, right?
Yeah.
But you need to have a client who appreciates some of these considerations, but also, once you break down all of these things, I find often a lot of the tax professionals I talk to, it's just like, just keep it corporate and just keep it easy, right? Like, no need to jump through, and kind of, commingle our waters, right?
Yeah.
So
The other I guess advantage of having that borrowing is where you've got large premiums and maybe you've got a relatively young person. I had one recently where the person's building a house, they're spending a lot of money. Their premiums were $120,000 a year, and they were running tight on cash. And how am I going to pay my premium? Well, that's another option within the policy itself, just to use that loan to pay the premium for a short period of time. Any problems with that or not?
yeah, so again, like, with as you can appreciate, one of the things that makes leveraged life insurance attractive is the ability to achieve interest deductibility as well in the system and get the collateral insurance deduction. When we use borrowed funds to fund a premium, we're now in a situation where interest deductibility drops off the table, right? So
Right, because
we're using borrowed funds
it's for a non-deductible.
Exactly. So we're now in a situation where we don't want to have the borrowed funds be used to do this, right? We almost want to have like a singleton type transaction where we end up selling an investment, right? Like, using the funds to purchase the policy or fund the premium, and then borrow against the policy and then repurchase. Exactly. So you nailed it right on the head. Yeah.
Interesting.
Can we go back to the scenario where we were talking about a holding company owning a policy versus OpCo owning it because the company gets sold and they want to take advantage of the lifetime capital gains exemption?
Yeah.
But you've got the problem where the policy is sitting in a holding company. And so what we were talking about before we started here was, well, having the holding company own a class of shares of OpCo.
Yeah.
And then using the income or the cash flow from OpCo to dividend up to pay the premiums. And then when the prospect of a sale comes along, redeeming those shares. Can you talk?
Absolutely. Yeah.
About that?
Yeah. I mean,
is that a common strategy?
I would say it's probably less common. Like, it's definitely an interesting alternative, like we were talking about before, where
what would be more common?
So usually it's just simply the trust in the middle structure, right? Where effectively, you start off, you're like, and for those of you who've worked with the trust in the middle structure, it's like, Mr. and Mrs. Entrepreneur starts off the business. Then they realize, oh, wow, I can multiply my lifetime capital gains exemption from my family members. Let's maybe do a freeze and introduce a new family trust to own common shares. And then the beneficiaries of family trust can include the family members, and it can include a holding company, held by the parents. Exactly, as a beneficiary. And usually that's what I find the common structure that's being deployed today. And as a result of that, what ends up happening is now you could pay a dividend up to the family trust, which can then allocate the holding company, and where that dividend is paid out of safe income, that could be a tax-free intercorporate dividend, right? So the beauty of this is holding it in the holdco beneficiary corporation is often a place that I've found very attractive for in situations like where you've got a regular operating business. For folks like dentists, for example, who are able to sell their practices, usually we see a sister company structure being used where, you can't have the holdco on top in many of the provinces. So what happens is you have a sister company where you lend the money over, and then eventually over time you eliminate that intercorporate loan through like a single wing butterfly structure. Right.
Now, in cases where you've got, let's say, an OpCo with two non-related owners, who own shares through holding companies. What I've seen is you've got like crisscross insurance, where holdco, Mr. A's holdco insures the life of Mr. A, but the beneficiary is Mr. B's
holdco.
Yeah.
And the same the other way. Is there any issue with that?
Because you were talking about having those disconnect with owner, beneficiary,
and
and
pair. Yeah. So this is an interesting question, right? Because I find that, in a structure like that one, what happens is if we have the other corporation, the other shareholders corporation be the beneficiary on your policy, the other shareholders corporation is going to get the death benefit and it's going to get the CDA credit. So then the next step in the journey is when you do a crisscross, the holdco, the second holdco, is going to buy out the first holdco shares in OpCo. So now, if we think about it, what we've achieved is the first holdco effectively has the cash, but it only has a CDA credit equal to its capital gain, right? So you're separating cash and CDA because the second shareholders corporation is basically getting a windfall of CDA, right? So the first issue in this is you're separating cash and CDA in the system, right? So and then the second issue that we face is now a different corporation is a beneficiary. So if premiums for one policy is different than another, could CRA come back and argue there's an indirect benefit to the shareholder who paid the higher premium, or like the shareholder who benefited from the higher premium, right? So these are a couple of the issues that come up. I find it hasn't really been contested on that front, but the bigger issue is that separation of cash and CDA.
Right.
So often I've seen an evolution where effectively, rather than having the other corporation being the beneficiary, we have OpCo be the beneficiary of the policy. And again, this is assuming there's no creditor issues down in the operating company that could prevent you from getting the money out of the operating company. But assuming, it's everything's clean, basically the operating company is a beneficiary on both policies. And then what happens is there's a subsequent redemption for the cash and the CDA. And what happens in that situation is now what we're doing is when we redeem, we create a deemed dividend, and we designate that deemed dividend to be a capital dividend, right? So effectively, what ends up happening is when you do it that way, you're able to benefit from basically the cash and the CDA ending up in the same place. So that I find is a better approach.
That wouldn't solve the problem though if if OpCo is sold, right? Then you've still got a policy that's owned there. This is just
in this case, the holdco would be the owner of the policy. So you basically solved the sale issue. So
I see.
So OpCo is just simply the beneficiary. But the issue that comes up, and this is an interesting one, because 246 CRA has said 246(1) of the Act may apply for the amount of the premiums, right? So I find that a difficult one to argue, right? But it's one of those things, and even in their description in the technical interpretations, they said it may apply, right? And it's a function of the circumstances. So I find the 246(1) argument is a difficult one because the reality is holdcos can capitalize OpCos, right? So I would say that it's fairly low risk, but at the same point in time, the CRA has said this is a risk. So I'm not here to tell people how to do their tax returns, but the point is I think it's relatively low risk, right? Is really the point I'm trying to make. So if we think about it and we break it down, in the event that we exit the business, we're now in a situation where holdco owns the policy.
Yeah.
Holdco's a payer of the policy premiums, and basically the subco is the beneficiary, right? So that's really, and in the event that we sell, we just turn the beneficiary back to holdco, right? So that's really the point here, where that may be the better structure from a buy-sell lens, just because it aligns the cash CAA in the same place in the event of
any tax consequence when you change the beneficiary.
No,
there is
no.
That's interesting.
Yeah.
So, Hemal, one other scenario, just for those watching, is, and I found this to be the case in the past with many accountants, where we get put in this awkward position. A client comes to us for advice, and we don't know the details of the policy, let alone the taxation of the policy. And so oftentimes, so that we don't look stupid in front of our clients, we just say, oh, no, there's a lot of issues there. And hopefully that'll go away, but that's not doing the client a service. And so how do we go about, what should we feel comfortable saying to the client realistically? And what's our solution for the client when we don't know the tax implications? We talked about this a little bit earlier, but is it, and oftentimes the insurance agents are the last person we want to talk to because they're pushing this because they get, a very handsome premium or commission on it, right? So what do you suggest we do as practitioners when we run into a situation like this?
I think I think the question that you have is an incredible one, because this is one of those things where, I was in your shoes, like, 15, 16 years ago, right? And we had similar things, because you don't fully understand the product, and, you may not be up to speed with what the strategy that's being pitched.
Or maybe there's two policies being pitched, and you're going, I don't know the difference between these features.
Basically, we said we need how do we hire someone like you? Because I don't imagine we can hire you.
That's right.
To consult in you being in your position. But
Yeah.
are there other yous out there
Yeah.
that know this stuff that can analyze?
Or do you go to a big firm like a PwC or an EY, and
Yeah, like and my short answer is as an independent practitioner, you've got the benefit of clients trusting you, right? Like, but it's also kind of like a benefit and a curse, right? Because now they come to you with everything, right? You're almost like their personal CFOs in many ways, right? So I could completely empathize. And the one thing that I would say is there's a short-term play and a long-term play, right? So the long-term play is the way the tax environment's going, right? Like, things have been whittled away in other areas, right? Like, between the 2017 tax reform, between everything that's been going on in terms of at the evolution of GAR, right? All of this stuff. Like, life insurance is going to be one of those areas that's going to be, primed for, like clients considering, because the reality is that the tax efficiencies, the CDA creation, all of that good stuff is something that is going to be something that's very relevant. So from a macro environment, I would encourage the audience to become more familiar. And like, the beauty of this is like, I haven't thrown in a plug for Manulife yet, but like, we've got a very robust library on our website, and we could share the link in the description below a little bit later on. Like, but really the first thing is familiarize yourself. Don't be afraid of the life insurance is really the point, because the environment is lending itself. In the immediate term, it's one of those things where, there's a lot of firms that are out there that do have like tax people on staff, right? That
they may have tax people on staff, but do they know specifically in the area of the Canadian taxation of life insurance?
So that's what I meant. Just to clarify, when I say firms, I'm talking about life insurance advisory shops that do have tax people on staff that can help, be it like, the independent advisor, or be it like, the big banks. The point is there are people there that, you could possibly bounce things off of. And, privately, Jonathan, if you ever, require that, I'm happy to be a second set of eyes for you.
Yeah.
And I've been the same thing, right? Where it's like, just if you need to bounce a question off. And the reality too, is this is in any market, you've got, like, one of the things I would say is like, there's a tremendous value to advice, and there's a lot of insurance advisors who do things the right way. So one of the things that I would say is like, if you've got an insurance advisor that clients working with, that they're like a member of like an organization like KLU, or like, they've got designations like the CLU, they're held to a higher standard than like, someone who may not have these,
that doesn't mean they necessarily know the tax aspects though, right?
That's right. But what I would say is generally with a KLU member, for example, they're far more familiar with the tax questions than somebody who may not be a member of KLU, right? So it's things like that where it's like, you could tell when somebody's been, given like a hard sale versus like, just getting good advice. And what I find is there is a very, very solid group of insurance advisors out there that provide the advice the right way, and I would say let's not discount that, because there is a tremendous advisory aspect to this.
The other resource that people should be aware of as well is the Canadian taxation of life insurance. That's publication, which a little bit about. What's your involvement?
Yeah. Great question. So for several years, I was responsible for updating chapters, and a couple years ago, I became a co-editor with John Natali, who represents the investment side of the business on the tax side. He's the head of TREPS over there. And then we also had Florence Marino, who was my mentor, my coach. Like, she was just she's an incredible person. I had the opportunity to be a co-editor with basically it was the three of us. For the 13th edition, John, Natalia, and I were the co-editors. We've got it coming out. It'll be likely in your, bookstore in the spring. But, I'd also like to throw a shout out to Florence Marino, who was a special advisor to the editing process as well. So,
Well, that is a book I have in my library. So, well, I don't know what version, to be honest. I've got back now. It could be version 7, but it was a very, very good resource. So for those, if you're looking for something in addition to going on to, I guess, Manulife's website.
Absolutely.
That publication also is a very good one. It's not cheap, but it's a good one.
Absolutely.
And then so much of our conversation has been around policies that would be considered exempt.
Yeah.
What about non-exempt policies? I've run into this. Have you ever run into a non-exempt policy?
No.
I ran into this a couple of years ago with somebody who immigrated to Canada and had a life insurance policy outside of Canada. And so am I on the right track?
Absolutely.
So let's talk about that, because I think we look at these things and assume every policy is exempt and has the benefits of falling under provisions of the Act, but not always the case.
No, you're right. Absolutely. So one of the things that, just because it has a life insurance wrapper from a foreign jurisdiction doesn't make the contract exempt from a Canadian perspective. And the best way to make the determination is it's not something that you and I can do as accountants. It's effectively something that we would need to engage an independent actuary to make that assessment. And once the actuaries make the assessment, we could determine whether it is truly life insurance or whether it's an investment product. Because what happens is like jurisdictions like, the US is our closest neighbor, right? Like, a lot of people who maybe US people migrate here with a US policy. Oftentimes it may be considered exempt, but you still want to do the test, right? And the other issue that you face is, even if it's tested as exempt, if there's big currency fluctuations in any given year, it may not be exempt because of the currency fluctuations.
Oh, wow.
But then the other thing too is when people come from like jurisdictions like Asia, the products are a little bit more blended. It's more like an investment product rather than a true life insurance product.
Yeah.
So you got to be cognizant of that, and that's why it's important to engage these actuaries to just make the appropriate assessments, and then B, just even reviewing some of the terms of the contract.
So Hemal, is there like a checklist that a practitioner can have just to draw on if they run into a situation with a client who maybe has come from another jurisdiction, or it's an old policy, or those types of things?
Yeah, actually, that's a great idea. That's something that the audience can actually reach out to me about in terms of coming up.
Yeah, very good.
Great. Well, I mean, there's so many more specific, nuances that we can talk about and get into this, and we don't have time for it now. But I think if anybody has any other specific questions or scenarios, maybe send us a note.
Yeah.
And maybe we can do a part 2 of this, because this is.
Well, we'd actually talked about using this as an opportunity to develop a course around.
Well, we can build it into a course, but one way or the other, I think there's so much more that we need to be aware of when it comes to the life insurance and related planning and tax.
And it just doesn't come up.
implications.
It just doesn't come up normally in our world. And the only time I remember is when the agent I work with calls me and says, "There's a Manulife presentation. You want to come down? I'll get you into it." And I'm sitting there thinking, we should be looking at this more often, because there's just, and sitting in our files, the whole issue of who's the owner of the policy, who's the beneficiary of the policy, all those things, right?
Absolutely.
And we don't even necessarily look when we're doing a year end to say, okay, well, we see the insurance premium, but we don't say to ourselves, okay, but that payment, what's that payment being made on behalf of, right? And Malafi's, I look. Yeah, dude. Yeah, right. Well, I do too. Okay.
As of today.
So the other thing, Jonathan and Ivan, I want to throw out to you guys, and also the viewers, the people who are listening, is Manulife is having its professional advisor forum, where we have the various accountants, lawyers coming out to listen to our team speak about life insurance and how things integrate from a tax and estate planning perspective. So would love to have you guys out. I'll send you the link once the link is active, but it's not out yet, but more to come. Stay tuned.
Okay. All right. Well, it's been a little while, and I know those events are oftentimes good. Sometimes they're product heavy, right? In terms of just introducing products and things like that. But I never find it's a bad time just to get my mind thinking around insurance again.
Absolutely. And the good thing is there's going to be a lot of good tax content too.
Okay, good.
And it's a good networking opportunity, and you actually get out and meet some people in the flesh as opposed to online.
That you might need their expertise in the future.
Exactly.
Yeah, absolutely right. Well, Hemal, it's been great to have you in today, and thank you for sharing your knowledge on this. It's been very helpful. Like you say, we could go on for hours on this, but we need to draw it to a close.
Yeah, but hopefully we'll have a more extensive course put together and cover a lot more of the details. Thanks for joining us for our first AJAG PD Pod episode of 2026. We hope you enjoyed it and took away some insights that you can apply in supporting your clients. Be sure to subscribe to us on YouTube or follow the podcast wherever you listen, so you don't miss what's coming next. And for expert-led PD courses, additional resources, and AJAG updates, head over to ajag.ca and you can join our email list. Thanks again for joining us, and we'll see you again soon.
Take care, everyone.